Today on Escape the Clock, we're aiming to answer the question, if hard work is supposed to be the engine of wealth, why does putting more effort into our investments so often leave us with less? According to Morningstar's 2025 Mind the Gap study, the average dollar invested in U.S. funds earned 1.2 percentage points less per year than the very funds it was sitting in, surrendering roughly 15% of those funds' total returns over the decade. That gap is not from bad picks. Surprisingly, it's from action. The same study found that the more investors traded, the less their average dollar made. We are conditioned to believe effort equals reward, but in the market, effort has a price tag, and it compounds against us. So to answer this question, I'll be joined by someone who paid that price for 40 years before flipping the script. You'll hear my conversation with David Nassief, author of The One-Page Wealth Compass, who was fired at 63 with a 2-year runway to broke, and became a multimillionaire by 69 by using a set-it-and-forget-it strategy that can fit on a single page. So today, we get into the specific moves that turn discipline into wealth, from the Wall Street lie that complexity is the price of admission, to the 2-fund portfolio that owns every publicly traded stock on the planet, to the income alpha shift that redirects your effort to the one market you can actually beat. And David brought the receipts, the actual month-by-month math behind how he doubled his portfolio 3 times in 6 years. So stay tuned for my conversation with David Nassief and learn how to stop tinkering, put your wealth building on autopilot, and finally let the system do the heavy lifting on your path to escaping the clock. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. We're taught that effort is the engine of wealth, that hard work, smart picks, careful timing, and active management will get us there faster. It's the story Wall Street has sold us for 100 years. And the data has been quietly screaming that it's wrong. Over the 20-year period from 2005 to 2024, 94.1% of all U.S. domestic equity funds underperformed the S&P 500 Composite Index. What this means is the professionals, the people who do this for a living, with research terminals and models and Ivy League credentials, could not beat a simple index over 20 years. Yet most of us still believe that we can. We open the trading app on the weekend and we tinker. We rebalance based on a podcast we heard, or we exit a position because our gut just tells us to do so. And each move feels productive. Each one quietly drains years of our timeline. The diagnosis is uncomfortable but clear. We're not falling behind because we're uneducated. We're falling behind because we're trying too hard. So what if the smartest thing we could do with our portfolio is just to stop touching it? What if the effort, the very thing we trust to grow our wealth, is the thing slowly bleeding us dry? What if a single page, not a strategy, not a system, just a page, could navigate us to freedom faster than 40 years of tinkering ever could? Well, today's guest is here to walk us through exactly that. David Nassief is the author of The One-Page Wealth Compass, a #1 Amazon hot new release that topped the charts in retirement, investing, and budgeting in its second month. He spent 40 years in the corporate world, being forced to retire at 63, and has spent the years since distilling the world's most effective wealth strategies into a single actionable system. Today at 69, he runs a thriving sales agency with his son and lives in Phoenix with his wife, Mary, sharing the same compass he used to navigate from nearly broke to financially free in under 6 years. David, welcome to Escape the Clock.
Dan, thank you. I'm thrilled to be here with you today.
You have this great book. You really take all these learnings and distill it down into great strategies. This is exactly the same thing I did with my book. So it was kind of cool to see that. And I know you spent decades, just like I was saying, trying to outsmart the market before you kind of had this revelation, I guess, that chasing returns and picking on these strategies and second guessing everything you were doing might actually be taking you back instead of forward. So I'd love for you to talk a little bit about when that realization hit you and what that was like, and then how you decided to move forward from there.
Sure, I would be glad to. First of all, let me just explain how it all began. I was 63 and I had just got fired after 18 years with the same company. I did the math, and if we drained all of our savings and all of our retirement, we were scheduled to be broke by 65. And I'm thinking, who's going to hire me at this point? But Dan, that wasn't even the hardest part. The hardest part was thinking as I drove home, how am I going to tell my wife, Mary? We'd been married for 30 years, and she did not deserve the mess. So anyways, after a couple of months of dead-end job searching, my heart was not in it. I did not want to go back to the corporate world, but I had to keep a roof over my head. I had to put food on the table. And everybody I interviewed with, they all confirmed that the company that fired me did the right thing, that I was no value anymore. And so, it's like I'm 63, I'm washed up. So anyways, I decided I have to take a huge risk. And I went to work as an independent sales agent on straight commission, no salary, no safety net, no benefits. The first months were brutal, cold calls, constant rejection, rookie mistakes. I heard more no's in that 2-month period than I've ever heard in any 2-month period in my life. But, Dan, as I look back on that, I can reflect now, thinking back, all that resistance I was getting, all that rejection I was getting, I really believe that was helping me build the mental muscles I needed to punch through that dark period of my life. After 10 months of grinding, I hit an incredible milestone. I was suddenly making more money than my good paying 6-figure corporate salary. And for a brief moment, I felt like we made it. But then I realized we didn't make nothing because I had made good money for 40 years. And look where it got me, on the verge of financial collapse. I says, I need to learn how to invest, but I don't have time for investment theories and people with conflicts of interest trying to get a commission off me. I need to learn this. So I read 21 books on financing. I listened to 13 podcasts consistently. I've read blogs, newsletters. I kept putting these good ideas on one piece of paper. When the paper filled up, I committed. I was only going to keep out one piece of paper. I want to keep it simple. So I would take the worst idea off and put the better one on. And I kept refining it and putting it on a set it and forget it approach because I had a company to run. I didn't have time to watch Wall Street and play all the games that I used to play for 40 years. So anyways, after 6 years, I did what I thought was impossible. From terrified of being broke, and I do mean terrified of being broke, to a 7-figure portfolio and real financial freedom. I now know it is never too late to rewrite your story. Because Dan, if I can pull that off starting as late as 63, anybody can with the right direction. And I truly believe that.
That's an amazing story. Going from a point where you're doing kind of what I might say is the traditional path, right? Of just working hard, following the script that you think others are finding, and then getting to the point where you should be done, but then being kind of life checked into realizing you're not going to make it, and then hustling again just to realize all you did is get back to that previous speed of the treadmill that you were on before. Exactly. And then realize, okay, something's off here. I need to educate myself and do something different. That's amazing. That's what this is about. I did something very similar and realized I had to educate myself. I read so many books. I did everything I can. I tried to do the same thing you're doing. Distill it, make it easy for people, because I know not everyone has the time to read 20 books and go figure this out. So I want to talk a little bit about how you got into the investing stuff, because it did sound like that came late in life. You were reading and realizing you had to make that kind of move. And look, it's getting more popular. More people are investing now. They're waking up to it. But I work with a lot of people, and there's a lot of fear about investing. There's a lot of fear about not knowing what you're doing or not thinking you have the time to do it properly. And we can get into a lot of the stuff about how Wall Street kind of preys on that, which we will in a second. But I'm kind of curious how your first impression was with it.
Well, first of all, I didn't start late in life investing. I was investing for 40 years the wrong way.
Was that like 401k and stuff? Like, what do you mean?
Individual stocks, buying and selling, buying high and selling low. I was a master at buying high and selling low. I mean, I had that thing down perfectly. But then I discovered doing nothing beat every strategy I tried for 40 years, everything. So it was amazing. But I just like to tell you how the compass piece of it came apart, because the simplicity of that is so critical for me anyways, because I'm the kind of person, I got to keep things simple or I'll go off track. Let me just tell you briefly, I heard this story. It's a true story. I heard about the same time that I was going through this nightmare. And scientists at the Max Planck Institute did an experiment. They placed people in the center of a dense German forest and told them to walk in a straight line to the edge. And these were confident and capable people. But when the clouds covered the sun and they lost their point of reference, the GPS tracking they were wearing showed they were gradually starting to walk in circular motion. Some of them were actually ending up right back where they began. But every one of them was absolutely convinced they were walking tracking in a perfectly straight line the entire time. Dan, that is me for 40 years, working hard, make good money, thought I was making the right kind of investments, but ultimately just going in circles, going nowhere. Well, I knew then when I heard that story, I said, I need a compass, but not a metal compass like travelers use. I need a one-page simple compass to give me that 30,000-foot view so I don't go off track every time I see a new shiny object or get a hot tip, because I was a pro at doing that, going off track. And so what it did is it gave me that executive 30,000-foot view the entire time, that 6-year period, and it just kept me on a path that I didn't vary from. And I didn't need a ton of discipline. I just followed the compass. That's all I did. And that's how that all things started, I guess you could say.
The average investor is trying to follow their own compass, like you're saying. And the average investor, according to a 2024 report, earned 16.5% in returns compared to the S&P 500's 25% return.
Yeah.
So that means the average investor did worse than just investing and the S&P 500, right? And 848 basis point shortfall is what that means. That's based on real research. Wall Street has been selling this idea for a long time that you have to have an active management to your portfolio to get ahead. Yet the average investor is falling behind compared to not doing really anything other than just investing in the broad market. So why are smart people failing here? And what did you figure out for yourself?
Well, first of all, Wall Street loves complexity, but the truth is simplicity is for winners. Complexity is for victims. And that's the truth. Wall Street needs victims. Otherwise, they don't get their cut of the money. And once I figured that out, that this is a lot simpler than Wall Street tries to make it out to be, wow, things change a lot. I didn't need an investment. And let me just add one thing to your statistic that you mentioned earlier about average investors not beating the S&P 500. I heard a statistic this morning that people who invest in the S&P 500, they actually do worse than the S&P 500 by a 1 or 2 points. And the reason is because, yeah, they're investing in that, but every time the market goes down, they pull out. Okay, then when it goes back on, when it goes back up, they pull back in again. And the crazy backwards market timing they're doing is actually costing them more money than if they just stay put. Okay, so anyways, I doubled my portfolio 3 times in a 6-year period. And most people who are savvy on investing and think, Dave, that's not possible. The market didn't increase in a 6-year period that much in that period. But let me assure you, I wasn't day trading. I wasn't chasing crypto, or I wasn't trying to time the market. I was doing the exact opposite. I was doing something so boring it would put you to sleep. What I discovered was when the market was down, I was thrilled. When other people were panicking and selling, I was buying more shares at discount prices. My only regret was during that 6-year period, the market wasn't down more, because I'd have even done better if the market was down more. But really what surprised me was something called the Rule of 72. I'm sure many of my listeners are familiar with it, but it says, say you're getting a 10% return on your money should double every 7.2 years, or roughly every 86 months. Once I had my compass firmly in place, my first double occurred in just 30 months. Okay. My second double, 13 months, and my third double, 29 months. And the secret wasn't the returns. I was doing 3 things I finally figured out that I hadn't figured out for 40 years before that. And here's the 3 things. 1, I was taking money off the top every time I pay myself and putting it aside into savings. Secondly, I was putting it in the right kind of investments, which, as you mentioned, is low-cost index funds. I only own 2 of them, Dan. That's how simple my system is. The only 2 I own is, 1, I own the total U.S. market. I own a little tiny piece of every publicly traded stock in the United States. The second one I own is every publicly traded stock outside the United States. So I literally own every publicly traded stock on the planet. For me to go to zero, the entire world economic system would have to collapse to nothing. And if that happens, we have bigger problems than money, okay? But that was the thing. That was a big awakening for me. And the last thing was market volatility. I used it to work for me instead of against me. Most people buy high and sell low, and I did that for 40 years. But once I figured it out, I was thrilled when the market was down. It's just like, if you were to go to the department store and they said 50% off sale, you wouldn't go up to the clerk and say, hey, when's that going back to full retail? I don't want no 50% off. I'm a retail buyer. They put you in the crazy house if you did that. But yet many people do that with the stock market every day. 50% drop. Oh my gosh, I got to get out in cash. No, that's when you want to buy more, not get out and put it in cash. And once I figured that out, I ended the cycle of buying high and selling low. And what happened really was I was able to build wealth twice as fast with half the risk compared to how I was doing it before and how too many people are doing it today.
Yeah, I want to emphasize a couple of things you said. One, people don't have to take our word for this. They can listen to the most successful investor of all time, Warren Buffett, who prescribes this strategy of buying at a discount. Basically, when it's raining, instead of running away, the people who have the buckets are getting ahead because they're taking advantage of those discounts. And I did something similar here. I realized that I wasn't doing as well and I was, worried about missing out on stuff. And so I wasn't necessarily buying at highs and selling at lows. I wasn't doing that necessarily. But what I noticed that what I would do was things would go high and I would start to go, oh, it's going to keep going high. I don't want to miss out. And then I would buy a little bit high, or I would sell some positions because I wanted to have some liquidation, some cash, so that if it did drop, I could have more capital to buy low. And then I would sell, but then I would have a little bit of a regret, like, oh, maybe I should have waited because it went up before it went down. But at the end of the day, I was still sold at a high. It wasn't the highest of the high, but it was still a high. So I've been trying to get over this idea that you have to swing trade at all the peaks. Like, that's ridiculous. No one's perfect. You're not going to, but like you said, if you can flip the script a little bit that way, you're coming ahead both ways and you're throwing more into your portfolio when you're getting a sale and it's growing. And I was going to ask you about diversification, but you already answered it. You take the total market, international and US domestic. That's great. It's really smart. So I'm curious, you mentioned you were beating returns really fast there, faster maybe than people would expect. Were you dumping a lot of new capital into your portfolio, or were you kind of swing trading better?
Let me tell you what I was doing, because I have the numbers right here. I don't want to misquote the actual numbers. What I was able to do was my doubles. I was watching the ratio of doubles. Okay. My contributions versus the markets. And this is so fascinating. Let me just share with you. My first double, as I mentioned to you, Dan, occurred in 30 months. Okay. Now my portfolio growth, okay, in that 30-month period, 2.5-year period, my contributions were 93% of the growth. The market was 7%. Now I admit I was making good money, but anybody who's starting out, Dan, whether they're making good money or not, the lion's share of the contributions are going to be coming from them because the market's smaller and it hasn't had a chance to no time to compound. But look at my second one. My second double occurred in just 13 months. Okay. And the market was really down the year before that. And I was buying. So really, when it went up, I had more shares and they all went up higher. My contribution now was 76%. The market was 24%. So it went from a market of 7% to a market contribution of 24%, which I was thrilled about. I was doing a little dance here. Okay. My third double was in 29 months. It took me to double at that time. And this is the tipping point. This is where I crossed the millionaire line. Okay. And my contribution was 62%. The market's was 38. So from 7%, 24 to 38. Now, well, there is a fourth double here. I did mention earlier. It was occurred in 28 months. This is when I reached multimillionaire status. Here's the contribution. My contribution was 47%. The market was 53%. All of a sudden, the market was now doing the heavy lifting and it was doing the majority of it. Okay, but that didn't happen the first double. I mean, it took a number of doubles, but every double, it kept increasing. And I tell you, I'm not here to tell everyone's going to be a millionaire in 6 months. That'd be a lie and it'd be very unethical to even say that. But I am saying this, if you follow the system, you'll be way better off in 6 years than you are today. Okay, way better off. Some of you may be millionaires. Some of you won't be millionaires. But what if it took you 12 years to get the $1 million? What if it took you 15? Is that really terrible? I think that sounds pretty good for a lot of people. But I'm just saying, it's about improving from where you're at. It's not like hitting a specific dollar. What my numbers are going to be different than everyone else's. We're all unique and we all have different situations, if that makes sense.
I mean, I watch people on game shows all the time killing themselves for the idea of winning a couple of $100,000, like it's going to change their lives. But the truth is, there are these boring and more, I can't say sure, but much more statistically probable ways of making multiple millions of dollars in time by leaning into compounding, leaning into mitigating your own behaviors by allowing patience in the market to do the work and things like that. I know with my son, I wanted him to get investing. He didn't have much incentive into it. So I gave him his first capital and I kind of guided him process, and he hasn't touched it once. And I point him to look at it and it's tripled since then. It's been a little over a year. So he's doing very, very well with his small portfolio, which has tripled, right? He has now thousands of dollars in there. That's really great. He's starting to wake up to the idea and he's 18. So, that's exciting.
That's great. That's
yeah.
good.
So, but for a listener who might, let's just say in their 20s right now, maybe they haven't put anything into the stock market outside of like an employer plan or something. How do you tell them to start? Because it is harder in the beginning, right?
Oh,
like you said, you're not seeing those doubles yet. You're not seeing that payoff. It just feels like you're throwing money in this thing. You have no idea if it's ever going to be worth it. For you, how did you deal with the anxiety of hoping that this was going to pay off? And of course, when it did, it's amazing. You're here, you're talking about it, doubling over and over at those degrees. That's like going from hundreds of thousands to millions to multiple millions and more. That's crazy, amazing. Well, how do you help someone who's earlier in the journey?
I think Benjamin Franklin said it good. He says, the best investment is knowledge. And that was so true. Once I understood the game and how to play it right, after reading 21 books, 13 podcasts, and a bunch of other stuff, I put it on one simple piece of paper so I didn't get confused and go off track like I had for 40 years. Once I got that down, I was thrilled no matter what the market did. I remember one year, I think it was 2022, you probably know this better than me, the market was terrible. I mean, it was a negative return by, I don't know, 18 or 19%.
For like the first time in like over 10 years. Yeah.
Exactly. And I had poured a ton of money that year. I made a ton of money, 6 figures I poured into the market that year. And every time I poured money in, my portfolio went down and felt up, and I was putting more money in. And I remember calling my brother once, and I was saying, I can't believe how exciting this is. I keep putting money in and it keeps shrinking my portfolio. I am so excited about this. And my brother thought I was crazy. Like, what are you saying? Isn't that like the opposite of what you want? But I knew what was happening. I was buying more shares for every dollar. And I says, when this thing recovers, and it will recover, because over 200 years of history, every time the market has gone down, it has not only fully recovered, but has gone on to new heights. 200 years of history is good enough for me. Okay. I feel comfortable with that deal. Okay. But I knew I was buying more shares for every dollar. And when this thing recovered, that's when the next year I had 13 months I doubled, because I kept pouring money in when it was down, everyone else was pulling money out and going to cash. No, I'm doing the opposite of that. And I tell you, that I was thrilled the whole time the money, I was hoping it would go one more year down. Like, just give us another negative year, just one more, please. They didn't do it. They went really up on. But I mean, what can you imagine if I had another negative year like that? Oh my gosh. I mean, when the recovery came, I'd even have more millions. But I'm just saying, once you understand the game, it's not scary anymore. But Wall Street wants to keep you confused and complex. So you need them, and you have to pay them with these ridiculous fees. And they sound so little, but they're really big. And that's the thing. When I understood it, my fears just went away. It really did.
Yeah, it's like a little crazy is good.
Yeah, exactly. If you use it right.
Yeah, I do think automating investing can be a useful strategy for people, especially if you're someone who you're like, okay, I know I need to be doing this, but for some reason, I just never do it. There's some kind of barrier there. I do know people sometimes worry about setting up an automated savings or investing because they worry that they need that money, but people's lives will typically size itself to what the money you have left. And it usually works out. But you can start small. But were you like manually going in and doing a transfer and saying, okay, that's the amount I'm going to invest this month? Or were you automating it in some degree? How were you helping yourself?
It took me 5 minutes a month to do this. I paid myself once a month. And so when the money hit my account, like I said, I took the percentage off the top that I was going to put in for investing. I would then transfer it to my investment account. Some of it went in U.S. funds. Some of it went in my international portfolio. Just 2. That's all. Just 2 portfolios. It's really easy. And then I click out and I'm done for the whole month. Because the reason I had to do it manually, Dan, is because my income varies every month. Okay. But if some people who are on a salary, you could automate it like you just said, and you don't even have to spend 5 minutes a month now. You can spend 0 minutes a month. Okay. And when you take it right off the top, before you have a chance to spend it, you just make the rest of the money work. It's just funny how that works. So it's just like, okay, it's gone. But if it's sitting there in your account and you don't invest it for like 2 weeks after you get it, it's gone. It's like, I got money. I'm talking literally the day, within hours of the money hitting my account, it is transferred to my investment. So I'm not tempted. I'm not enticed. I'm not confused about, oh, is this money mine or investment money? 5 minutes. I don't need an advisor to do that. I could do that myself, and I think my results speak for themselves. I think I do much better than any advisor would have done for me. I'm not saying I'm smarter than advisors, because I'm not. I don't know a lot of technical stuff about the Wall Street stuff, but I know what works for me. And man, that worked for me wonderfully.
On the technical side, I was really interested to hear you talk about alpha a bit. I wanted to get into that because when I was getting my finance degree, alpha is I don't want to get too technical for everyone here because it could get too dry and boring. But, this idea of how do we statistically look at the market and know that we're maximizing for a return? There's a lot of complexities with these different factors like beta and alpha and things like that. I was wondering if you could help simplify this for the audience a little bit, talk about like market alpha versus like income alpha, maybe in plain English a bit, just to help people understand how you made this work.
I love your thinking, Dan. I mean, you and I are like on the same wavelength. It's shocking. I've done like 80 podcasts in January. No one is like so connected to what I think is you. Anyways, I believe in alpha and I believe in beta, but I had it reversed all my life. Okay. Now I got it in the right way. Beta means you're getting market returns, okay? And that is so much better than anybody trying to go for alpha, which is above market returns in the market. You're competing against supercomputers and teams of PhDs who can't do it. They can't do it. And you're supposed to do it. Oh my God. Let me tell you, my wife, when she was a youth, they gave her an IQ test. She was 1 point away from genius category. When I was a youth, I failed the second grade. So I always say together, we make one average intelligent person, the two of us together, okay? I am not a smart guy. I really am not.
You're bringing down the average, David.
Yeah, I know. So I'm telling you, I am not that smart. I had to keep it simple. And when I made my compass, I says, I want beta. I want market returns because everyone trying for alpha typically goes under beta. They don't get just beta if they're trying, hey, I'll go for alpha and at least maybe I'll get beta. No, they go below beta because they're messing with things. The market timing causes problems with taxes, causes expenses with fees. Just so many things we could talk about for quite some time. And it's just goofy. I just buy it and set it and it gives me market. Okay, I want beta. I love beta. I jump for joy with beta. But for my income, see, this is where everyone has it wrong. They think, well, I got a salary or I got my paycheck. There's nothing much I can do about that. So I'm going to try to beat those supercomputers and those PhDs because I have a better chance of beating them than I do in my own little local market. That is crazy thinking. They say that the market is very efficient, which means everyone gets all the information at the same time and the market is what the market numbers are. Okay. But let me tell you what's inefficient, the local market in your profession. It isn't a bunch of supercomputers and PhDs competing with you. This is not that situation. And in the local market, you can capitalize on the inefficiencies and get alpha income. And that's what I got, alpha income, above average income from my local market because there are so many inefficiencies in the local market in Phoenix, Arizona, Houston, Texas, Boston, Massachusetts, wherever the heck you're living. Okay, this is not like everyone's not out globally on your little market and your specific profession either. So you have a much better chance with what I call a one-page career compass. I took my same one-page wealth compass. If it worked for the money, it worked for my career. And what I was doing when I built my agency is I was reading books on startups. I was bringing books on marketing, on sales. And every time I got a good idea, I put it on my compass. But this time I could test it out in the real local market. And if it worked, it stayed in my compass. And if it didn't work, I got bumped off my compass. Okay. And when I did that, I got an unfair competitive advantage in my local market, which gave me an unfair competitive advantage in my salary and my income. And when I did that, I could pump more money into my wealth building machine now, which was getting me beta. And all of a sudden now I am just doubling much faster than any Wall Street genius is doing. And I'm the guy who failed second grade. Okay. And that's really, when you put those two together and do them right, oh my gosh. So anyone says alpha's dumb, no, they're dumb. Alpha's great for income, but it's terrible for the market.
I kind of have my own, I guess I'd call it a life compass in a way, because I'm an early retiree and I kind of put together a plan. I was a program manager, so planning is what I do, and I like to execute and mitigate risk. And that's how I accomplish my financial independence. But now I do that for my life goals because I want to enjoy this retirement as much as possible. I think of time as a capital. We have a finite amount of it. We get to spend so much before we die. And I'm trying to do that in investing in myself, learning. I got a degree. I'm trying to master my hobbies, learning new skills. Like you're right. Locally, there's opportunities I see all the time. Like I could buy this business. I could do this. I could do that. And it's really interesting when you have the time and energy, what you can really accomplish. And I did want to talk to you about retirement because you're not a fan of traditional retirement. That was pretty clear. You even coined your own term. I think it was FIGNA.
Yes.
I was hoping you could explain that to the audience as well and why you think traditional retirement fails so many people when they finally feel like they arrived at that number or that moment.
FIGNA, again, financial independence, graduate to next adventure. I'm sure your listeners have heard of FIRE movement, financial independence, retire early. Okay. And I'm not against the FIRE movement, but it's not for me. Okay. I'm not saying it's negative at all. I'm just saying it's right for you, then good. But what I want to do is I don't want to ever retire. I want to graduate and things. Matter of fact, Dan, I would challenge you. I don't think you've actually retired. I mean, you're doing this podcast, you're doing investing.
That's what my family tells me all the time.
Yeah. Your kind of retirement, my kind of retirement, I think are very similar. I just want to keep graduating. When I was 63, I started my own company. When I was 72, I started a book. When I'm 82, Dan, you'll have to have me back on your show at 82 and see what I'm going to do. These are just new adventures. But here's the reason I like graduate to the next adventure. When I was 62, I had two obstacles that were major. One, I failed for 40 years on investing. If I hadn't done that, figured it out, I wouldn't be sitting here today. I don't know what I'd be doing. But the second thing I had on the same thing is I had a career that imploded. No one wanted to hire me. I was a 63-year-old has-been, and no one believed in me. And so I had not just an investment problem, I had an income problem. I had 2 David and Goliath battles, and I was David in both of those, unfortunately. And it was a real major battle. And it wasn't for my 2 compasses that I had giving me an unfair advantage in both fronts, I know I wouldn't be where I am today. And so at FIGNA, I see so many people my age or older or younger, whatever, they retire and something happens after 6 months to them. Their face looks different. They walk differently. They talk differently. We live in a beautiful golf course. I mean, it is amazing. I look back at the golfers and I go, I hope you guys are having a good time. Nothing against golf, but I just couldn't do that. I mean, it's fine sport. You're outside in the sun. That's real healthy. But I just can't. I have to be doing something productive that I feel is productive and making a contribution. That's why I love my volunteer work I do. I love spreading the word on my one-page wealth compass to help people so they don't in the same boat I was. And I also love my agency. My son's joined me now, and we had a record year last year. It's just going phenomenal. So I couldn't sit down and watch TV and, I don't know, play whatever they play.
Well, it's inspiring to me that at your age, you still have that energy and that passion. I love that so much. And I hope that's me. I hope I don't lose that because, retirement, it means to go out to pasture, right? It means you're done. Yeah. You're too old to enjoy, do stuff, right? I don't know if I believe that. I have health goals and things like that. But you did mention fire. So I wanted to kind of get your deeper thoughts on that for a moment, because people who listen to this, they know the fire community. Some people are probably following fire, and, Coast Fire can be really effective, and they're good strategies depending on what you're trying to do and where you're trying to get. But I do find that the retirement phase itself, the financial independence phase, like when you finally get there, is where people in that community struggle the most. I was curious how you look at that. What are they missing for that phase compared to what you're talking about?
I think they're missing FIGNA. They're just, okay, I got the goal, and then what happens now? You only go to the beach so much. You only play so many good games of golf. And I talk to so many people when they're retired. They're, you only can play so many games of golf. Like, it's kind of boring after that. It really does. If you're not some kind of purpose, maybe higher than yourself, even if the money's no longer an issue, then do something to help other people or whatever. You don't have a purpose. You only go on so many trips to Europe and to Asia and all that kind of thing. And it's fun. But after the honeymoon period's over, from what I've heard so many people, I mean, I'm 72 and I'm never going to retire, but I've heard that after about a year of honeymoon, it's almost an emptiness. And I understand it. I can see that emptiness because that's sad. Here's the thing I'm not so thrilled about with fire is, live like a monk for a decade or two and don't have any kind of life, just pour money. And then, no, I think that's wrong. I didn't live like a month for that 6-year period. Like I say, with the alpha income, and I don't mean alpha income like, I worked overtime. No, you've got to work smarter than that. You got to work so your dollars per hour are going up for effort put in it. When you have alpha income and you take all that brain power that you were using for market alpha, which is a waste of time, and put it to local market, you'd be shocked how quickly we did not live like monks for that 6-year period. And we certainly don't live like monks now. We also had a life too outside of work during that 6-year period because of the alpha income piece.
Some people might be listening and hearing alpha income and curious if you were leaning heavily into things like dividends or stock options or CD or bond interest to generate cash on that portfolio that you were not fiddling with too often. How big of a piece of the pie was that for you?
Zero. Absolutely zero. I didn't even consider. When I say alpha income, we're off the stock market now. We're not even talking about stock market anymore because I've got beta and I'm happy with beta, okay, on the stock market. I'm talking about using my own compass to give me an unfair advantage locally with local people and not supercomputers and PhDs. Okay, and I can beat them. Even somebody who failed the 2nd grade can beat them with the right kind of compass, with the right kind of knowledge put into that compass. Not just, I'm just going to do it because I'm just going to work hard. No, it's not working. It's really working a lot smarter and getting that compass. So, I tell you, if my competitors got a hold of my local compass for my income, I would not be happy about that. But here's the thing. This is the actual one-page wealth compass I have. You can take this and use it as a template for a career compass to make that go much higher for you than waiting 40 years like everyone else does and just getting what you get.
Well, David, thank you so much for coming on the show. How can listeners connect with you and find the Wealth Compass?
Absolutely. I have a gift for all of your listeners. It is the literal one-page wealth compass that got me from 63, almost broke, to 69, a millionaire. And it's the same thing that you can have. Go to onepagewealthcompass.com/free, onepagewealthcompass.com/free. You can download this one-page wealth compass instantly. And I tell you, it will keep things simple for you. It'll give you a simplicity that few people ever achieve. And it'll cut out all the noise and all that confusion that Wall Street wants to put in this because it's not that confusing. Just go to onepagewealthcompass.com/free and get your own one-page wealth compass.
Well, thanks again, David, for coming on Escape the Clock, and I wish you the best with whatever comes next.
Thanks, Dan. Appreciate the opportunity.
I'll be honest about my own scorecard here. I told David I had never thought of myself as a buy high, sell low investor. But when I traced my own behavior, there it was. I had bought into positions that were starting to climb, and it would go up and I'd feel delighted. But as it climbed, I started to second guess not having bought more. Now, the smart thing would have been to wait, but the fear of missing out was just too strong. And so I purchased more, thinking that it would just continue the climb. Then, of course, it would swing the other way. And in a few cases, it would swing back down so far that it was actually under the original position price that I had originally bought in at. Not only did I buy additional shares at a high, I missed out on getting all the positions at the low. And every one of those moves had felt smart in the moment that I first initiated them. Yet none of them were free. Now, I wish I could go back and just A/B test my investing career to date using everything that I've learned and compare the difference. I would love to know how my portfolio would look today if I had bought in full every time and just forgot about it, just left it alone. The data says that I would have done much better than I have. David spent 40 years doing that same dance, and he put a name to why. Scientists at the Max Planck Institute placed people in a dense forest and asked them to walk a straight line. And when the clouds covered the sun, the GPS showed them drifting in circles, some ending up right back where they started, while every one of them was convinced they were walking straight. That is investing without a fixed reference point. Effort, confidence, motion. No progress. His fix wasn't more knowledge. His fix was less surface area. And the result was one page of learnings condensed for simplicity. He called this his compass. And with it, he built a portfolio of exactly 2 funds. Now, that doesn't sound like much, but each of these funds were broad market, low-cost index funds. First was the total U.S. market. This gave him a piece of every publicly traded company in the country. The other was the total international market, and that gave him a piece of everything else. So David went from hustling for W-2 income to autopilot, where as long as economies existed and grew, so did his wealth. He even understood that his biggest risk was himself. Instead of fiddling, he took a fixed percentage of every payment, moved it to his investments within hours, and then left no room to negotiate with himself. That cash became opportunity money for down markets. When either of those index funds were hurting, he grabbed what he could afford at a discount. And that is it. That's the entire playbook. The simplicity of it is that it stops there. The rest of the magic was the rule of 72. And here's the math that he shared. The rule of 72 says at a 10% return, your money doubles about every 7.2 years. Now, David's first double took 30 months, but 93% of that growth was his own contributions. His second double took 13 months, so a little over a year, and the market carried 24% of it. His third double was 29 months, so over 2 years. And it's here was where he crossed the millionaire line, with the market carrying 38%. But by the fourth double, the market was doing more than half of the work, 53% of all the work. That is the honest shape of compounding. The market's contribution went from 17% to 24% to 38% to 53%. More and more lifting, higher balances. Now, if we could look under the hood, I think we'd see a few interesting things. The first double is the grind phase. This is the early stage where the portfolio is too small to generate massive raw dollar returns. We have to do a lot of the heavy lifting in this phase, dumping as many contributions as is reasonable to speed the compounding. The doubling is mostly from our own contributions. The market can do some, but it's mostly coming from us. The second double is where the momentum is created. This is the acceleration phase. Contributions are still required, but growth is now evident. The speed of doubling, though, is contingent on market yield. So a strong market requires less contribution. The third double is where the millionaire line should be crossed. The portfolio becomes large enough that the market's share of the growth is too big to ignore. Basically, the portfolio's gravity is starting to pull its own weight. The fourth double, though, that's the tipping point. This is the snowball effect in full motion. And, for the first time, compounding is doing the majority of the work. With good market yields, the 7-figure portfolio can easily outpace our own human capital. In other words, the portfolio generates more money on its own than we can earn working. So what I just went through was an illustration of the power of a strong investing plan allocated to growing positions with low drag. And I know I mention drag often, but it's an important concept that I think is really worth understanding. The SEC has shown that a 1% annual fee on a $100,000 portfolio growing at 4% consumes nearly $30,000 more over 20 years than a 0.25% fee. So small numbers, but big holes. So if there's a takeaway from this episode, I'd like you to consider this. When the supercomputers and team of PhDs can't beat the indexes, why do we think that we can? True wealth is being created every day, and every extra dollar that you position correctly is the fuel of growth. You ride the beta to the goal, and then graduate into the next phase where you can alpha your income towards your ambitions. Now that is escaping the clock. I'd love to hear from you. If your entire financial plan had fit on one page, what's the first line you would have written? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thank you for listening, and best of luck simplifying your system and escaping the clock. I'll catch you next week.
That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. I'm Daniel C. Rogers, a wealth management certified professional and your host. The book, the free planner, and the one-on-one time with me are all waiting for you at EscapeTheClock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.